Hello and welcome to Livewire Markets. I'm Ali Selby and today I'm joined by MLC Asset Management's Anthony Golowenko for a look at how investors can access quality cash flows in this market environment. Thank you so much for joining me, Anthony.
Thanks, Ali. Great to be here.
Interest rates are set to rise over the coming years, not just yet though. It's still quite a hard environment for income-hungry investors to try and get some yield. What's your view of interest rates and term deposits in this environment?
Well, certainly the dynamic in central banks, primarily through going back post the global financial crisis, cash rates were moved to emergency settings. Now, at the end of 2018, there was actual more meaningful interest rate increases. Now that very early in 2019 turned around, and since then, beyond conventional measures, central banks have increasingly adopted unconventional measures, and the result is the world is awash with liquidity. What that unfortunately means for those investments such as term deposits or even outright cash rates, they have been demonstrably decreased, and their role within a portfolio to meaningfully deliver on that foundation of income has been certainly less than it was. The interest rate outlook is certainly some time to adjust, and what's going to be a very gradual process to get to the future state and desired end state of near full employment or moving towards full employment, and also moving towards meaningful, sustained real wages growth. And we are, at least at my view of the world as it stands now, many years away from that. So unfortunately, not a lot of good news in terms of term deposits and cash rates. There is an ability to incrementally achieve some yield and some income, but certainly be aware of the risks that you're taking to achieve that.
I just want to touch on something that you said before. Do you then think that term deposits have a place in investors' portfolios in this low interest rate environment, or should investors be looking elsewhere?
I think the terms of deposits are interesting. The underlying banking system, and as I touched on with central banks, certainly there's a lot of liquidity. Now that means the need for capital or the need to deposit for deposits is not that what it was. Probably good news is that for a movement or a migration into online banking, and those online banks having much lower overheads, have an ability to offer at least incrementally higher yield. So it's not all bad news. It's not all bad news for term deposits. Probably they're evolving in the way that they are being delivered. We would advocate liquidity and being clear on liquidity requirements, and certainly not taking a lot of risk there. But beyond that, and even incrementally into unlisted investments, an illiquidity premium or a complexity premium to be harvested. Increasingly, we're seeing those sorts of opportunities become available, but advocate that certainly as part of a diversified approach.
Where can investors access quality cash flows in this environment then?
Well, I think there's a range. And again, from a standpoint of risk and reward, we'd view these mid-risk assets, so sitting between traditional bonds and fixed interest and credit investments, but nowhere near or not to the same extent of risk as equities and even private equity. So global listed infrastructure would see in that environment offering appealing cash flows beyond and looking into the medium term. We like the nature of them keeping pace with inflation. So when I say real cash flows, that's what we're seeking to harness within our portfolios. And whether that's an airport, a toll road, critical transmission lines, or other water transport, those sorts of investments, we view those having a place in providing a foundation of regular, meaningful income. Also within REITs, and probably in the one area we're not quite there in terms of the risk reward is big box discretionary retail. But beyond that, whether it's industrial, whether logistics, high quality office, neighborhood shopping, and even some of the more niche subsectors around healthcare and agriculture, which are, it's very slowly becoming available in listed markets, and more so a much broader opportunity set in private markets.
Are there any names that you could share with us?
Well, I think the real estate subset within Australia, recent results that have come out and been quite strong. We see Centuria Industrial coming out with, I think, a growth pipeline, but also doing hard work in terms of leasing and quite meaningful asset revaluations. Beyond that, Charter Hall just this week have come out, and I think across a multi-channel funds management business, core office, industrial, logistics and partnership. And what they've done now looking back over 7 years, deliver actually north of $10 billion in strategic partnerships. And by doing so in a sale and leaseback, can work collaboratively and constructively with their clients. So there's two names that we see within that REIT space that have delivered really consistent results, are growing, and can deliver meaningful real cash flows. Other areas, in industrials, you may be looking at a different journey and potentially moving upwards outside of that sort of REIT and global infrastructure. But something like Amcor, we saw a result there, increasingly global business, very well managed. The major Bemis integration and acquisition is bedded down and they're extracting costs. We just see that as being a steady, diversified, very well run, very well managed business, and having a role within, I guess, a quality core, particularly in delivering consistent income that's going to grow in line with inflation.
Okay, Anthony, is there anything that you think retirees should be excited for in this environment? I mean, we've seen incredible dividend growth out of the banks and iron ore miners over the past year. What are your thoughts on that?
Well, certainly from where we've come from, I appreciate the view of term deposits and major banks as a sole source of franked income that's been challenged. Fortunately, we have seen a range of investment opportunities and a range of yield-related investment opportunities coming back online, and certainly major banks, the results were resilient. Seeing off-market buybacks, which can provide, and again, not giving any tax or financial advice, but can provide a real benefit to those retirees. And you mentioned the major miners, and where we're looking there is really around a low cost of production, high quality, long mine life, and access to infrastructure. And that combination, and even if we see prices moderate from these levels, the volumes coming through, the demand for steelmaking, the demand for infrastructure, the demand for key materials, of which Australia and major miners have and deliver amongst the lowest costs in the world, that certainly is a bright spot for retirees. We would just probably remind, and maybe the experience over recent years, is banks are effectively now lending machines. They're exposed to the broader economy. So a more diverse approach and resilience in looking to deliver that. And beyond major miners, we're also seeing industrial companies. A name that jumps up is something like Amcor, that may not have the highest yield, but it has a growing business, a very well-managed business, defensive attributes, and really high quality. So as part of a diversified approach, seeking income and dividends, we'd see those sort of investments representing, I think, what retirees do have and have something to look forward to in this environment where yield, as you mentioned, has been challenged.